And joining us now to talk a little bit more about the U.S. markets and what we're seeing is Ryan Gibbons, managing partner at GPS Capital Markets. And still with us, of course, our guest host, Jens Norvig. Ryan, let's go ahead and start with you. It was pretty amazing what we saw yesterday. No real catalyst for the market moves leading up to the Fed speech. And of course, we got what we expected from Chairman Bernanke. And then 3 o'clock, JP Morgan comes out with this announcement about boosting its dividend and its stock buyback. And it spurs the Fed to say, you know, we're going to have to come out early and release the bank stress test sooner than we thought. What's your take on this? We saw a huge move on the Dow yesterday.
It's kind of perfect timing, isn't it? You get it late in the day, you get people who are not expecting something, even though we probably expected most of those banks to pass that test. It was more a little bit about the timing. I'll be a little bit interested to see what happens and see how much euphoria was in that, and the fact that they kind of beat the Fed to the punch, and then the Fed had to react. And so it'll be interesting to see how that plays out today. But it's nice to see those banks come back and actually, in as much, get their act together a little bit, start acting like banks again. And I'm hoping that that's a catalyst to see us actually see the banks start lending again and get some of that money that's on the sideline back in play.
Certainly some good news, as you said, and some euphoria for the banks that were able to say, look, we're going to boost our dividend, our capital ratios are high, we're going to buy back some stock. That always is good news. But what about the banks that didn't pass, Citi in particular? Yeah,
you know, Citi, they didn't miss by much. You know, it was 0.1% on one of the ratios, and I think that they quickly said they will go back and adjust, and I expect them to be right in line here soon.
Okay, interesting. And your take on Citi, Jens? I'm just curious.
Well, I think overall the important thing is to keep in mind that this result came out, but the reason why it could have like this market impact is also that the global situation is much calmer. When we had all the tension around the European bank exposure, I don't think we could have gotten the same reactions. And I think it's a reflection of the fact that we have a much more calm environment in the global banking system than 3 months ago, and this means that positive news actually has an impact on the market that wouldn't have been the case 3 months ago.
Guys, if I could just quickly jump in here. Ryan, do you think, do we know the specific criteria as to how they stress tested the banks, given that some people have been suggesting that maybe NPLs, some of it, is not being classified as NPLs? I mean, let's face it, we still have the subprime issue, and housing prices are still depressed, even though equity markets have performed well.
There's a lot of information to dissect and go through that. I spent the better part of the evening last night just trying to dig into actually what the Fed had said. It's some 80-plus pages, and that stress test is pretty it's pretty in-depth, and there's a lot of hypotheticals in there. What I found interesting was that Ally Bank, which is 74% owned by the U.S. government, was one of those 4 that failed the test, and they came out and said that they were too stringent and those hypotheticals were off. So it's interesting that you have the Fed, who is looking at doing they're the ones that are looking at auditing that and making sure it's happening, and yet the federal government is also saying it might be a little too stringent.
Yeah, that's a really good point. Let's leave it there for the moment. We're going to come back to you guys in just a minute. But meantime, the Fed, as expected, is keeping its interest rates at record lows and will continue its Operation Twist program. In its statement, the Fed downplayed recent strong economic data. It also added language saying unemployment has declined notably, but still remains high, and repeated that housing is depressed. Now, the Fed did note that rising U.S. gas prices will boost inflation in the short term, but longer term prices will be subdued. Ryan, I want to come to you on this, and if we could just for a second take a bite from Bill Gross. He was on CNBC yesterday. He took a contrary view. Just let's listen to what he had to say.
I think the Fed is playing a game with us to some extent. It's the same game that, you know, that the Bank of England's Mervyn King plays in terms of writing letters of apology every 3 months, you know, to explain inflation for the past 3 years, which has been far above target. I think the Fed will continue to do this for a long period of time, and therefore subordinate investors in the bond markets.
Okay, so Ryan, do you agree with PIMCO's Bill Gross?
Yeah, I think he's on the right line there, the right line of thought. The Fed is they're acting a little bit like a surgeon, you know, a little bit of a puppet master, if you will, trying to get everybody to march to the right beat to try to see if we can't get this economy going again.
Okay, and Jens, your take?
I think the important thing to keep in mind is that they wanted to ease, but in terms of the inflation numbers, it's been coming in a bit higher than expected, and growth has also been coming in but higher expected. It's going to make it harder for them to implement another round of quantitative easing, even if that was the plan they had a few months ago. So the data will be absolutely crucial over the next 1 to 2 months, I think.
What do you think Ryan will kind of cement the beginnings of a recovery that we're seeing in the US economy? What are the factors that need to come through for that really to be driven home?
If you start seeing, and I think we've already started to see that, I don't think that there's going to be a bell that goes off that says we're there. You're going to end up seeing, once I start seeing the banks and those credit facilities and them loosening up the credit, I think that will be the one piece of market news that you don't really get on the television or in the papers that will tell me and the clients that we service that we're really full steam ahead.
And Ryan, last question to you. I just want to see what your thoughts are regarding the stress test yesterday. The way JP Morgan came out with that announcement and prompted the Fed to make an announcement that it wasn't planning to make until Thursday. Right. What's your reaction to that?
They said it was a miscommunication. And you know, whether it was, and it probably was. I think that they were excited to say, let's get back to, let's give something back to our investors. Let's see if we can't make this stock price go somewhere. And in all sense, it was just exactly what I expected them to do.
Okay, all right. Thank you so much to Ryan and to Jens, of course, who is going to stay with us. Meantime, still with us is Ryan Gibbons, managing partner at GPS Capital Markets, and Jens Nordvik as well. And I want to start with you guys and talk about some of this data that we've been seeing. Besides what we saw from the Fed yesterday and the stress test, right, it's really all going to be about growth in terms of how Chairman Bernanke proceeds and goes forward. So we need to see more positive data showing indications of growth. We need to see the unemployment figure continue to come down. Jens, do you think that that's going to be a reality?
I think the important thing to keep in mind is where expectations are now, and as opposed to if you go back to the beginning of 2011 or the beginning of 2010, expectations are still quite moderate. So I would say it's less than 2.5% growth for the remaining quarters of the year. So that's not impossible to beat. Certainly if we get a bit of self-sustaining momentum in the labor market, we could potentially get above that. I think once expectations have risen, and I think we're in a process where those expectations are rising, it's going to be much more difficult to beat the bar, but I think we can probably for the next couple of weeks see better data.
Okay, well, it is all about expectations sometimes. And Ryan, I want to get your take on this. Have we set the bar kind of low just specifically so that we could beat it?
Yeah, that's what I was thinking is that we've been predicting such gloom and doom for so long, and my take has been in the last 6-8 months we've seen businesses doing better, and here we are seeing a little bit more data that's showing, and they're revising upwards, and you see what's going on now at the banks, and hopefully I take note that Bernanke's talking to bankers today, and I'm sure he'll play that up, and I think that we're starting to see that snowball form, and it's starting to take the momentum and pick up steam.
Okay.
But Ryan, we had a guest on earlier on CNBC saying it's all well and good seeing these markets rallying, but we've been printing money like billio, and inflation's just going to come and bite us very soon. Would you agree with that view?
We are on there's no doubt, and I don't want to preach too much sunshine here. We are still in a precarious position, and anytime you start printing money, you're on a slippery slope. And I think that there is definitely an opportunity here for us to weather this storm, and hopefully we'll do that. But I'm starting to see businesses drive that, but I am concerned about the amount of money we printed.
Jens, this dollar rally that we continue to see, whether it is a risk-on rally or risk-off or better data, is that going to continue?
Yes, the big news over the last couple of weeks is that we've seen the dollar rally together with risk assets, which is a very big departure from what we've seen over the last several years. So that's something new, and I think in the short term that can continue. And the main reason is really that growth expectations were so low, and then also that the Fed has got some competition in terms of printing money. The ECB is going down a little bit the same route, and I think the euro is becoming the funding currency, and that's supporting the dollar.
Absolutely. Thank you so much for that. We are out of time, but we do appreciate appreciate you joining us this morning. Ryan Gibbons, managing partner at GPS Capital Markets, and our guest host Jens Nordvik, global head of G10 FX strategy at Nomura.